All right, welcome back to Finance Deep Dive. So, we've covered a lot, right? We've talked about risk, about tightening, opportunity, but today we're going to dig into something a little more subtle. We're going to look at why that exact moment you start to feel safer might actually be when you're losing your edge.
Okay, you know that feeling, right? Recoveries, they just feel good.
You see the markets start to bounce back. The headlines, they finally start to improve. And all of a sudden, yeah, confidence is back. But here's the kicker. That early recovery, that can be where the absolute most expensive mistakes happen. It's a total paradox, isn't it? The very moment things start looking up is precisely when we become the most vulnerable. And that right there, that brings us to what we're calling the relief trap. And it is fascinating. It's all about how that amazing feeling of safety can completely sabotage your entire strategy.
I mean, think about it for a second. When you're in a downturn, you are on high alert. Every single decision gets put under a microscope. Every dollar is tracked. That pressure, it keeps you sharp, right? But the second that pressure starts to fade, what happens? The discipline fades right along with it. It's just human nature. You let out that big sigh of relief, you loosen your grip, and bam, that's exactly where the trouble begins. And this isn't just a feeling. It leads to some really specific changes in behavior. All of a sudden, those strict plans you had, they become more like loose guidelines. You start making new commitments, because you're thinking, hey, the good times are back to stay. You start increasing your exposure, chasing after those returns, all because the danger just feels so much smaller, so far away. And listen, this is the crucial point right here. Just because conditions are improving does not mean they are stable. There is a massive difference between those two things. And confusing them, well, that is a really, really costly mistake to make. So this leads us perfectly into our next point, the massive gap between price versus reality. You've got this huge disconnect between what the market seems to be pricing in and what's actually happening on the ground. Okay, so let's really break this down. On one side, you've got the illusion, right? Asset prices can just snap back like a rubber band, super quickly. Optimism is soaring and it feels like taking on more risk is getting rewarded. But the reality? It's usually a very different story. Real, true certainty, the kind that's built on a solid foundation, that comes back way, way more slowly. The whole environment underneath it all might still be incredibly fragile. Okay, so if this gap is so obvious, why do so many of us fall right into it? Well, it all comes down to psychology. It's something we're calling the confirmation craving. We are basically hardwired to want to believe the hype. So why is this so darn tempting? I mean, why do we leap at the very first sign of green shoots, even when, deep down, we know things are still really uncertain? It's because we're desperately searching for signals. Any signal that confirms what we're hoping for. We're looking for that proof that says, okay, the worst is over. We want that permission slip to finally relax after all that stress. And maybe, more than anything, we are just craving a reason to feel certain again when the world feels anything but. And here is the real trap. The market is fantastic at giving us exactly what we're looking for. It offers up hope, and it offers it up early. It's basically a mirage in the desert for an investor who's just dying of thirst. Okay, so let's talk about the real cost of rushing in. What's the actual tangible price you pay for that premature confidence? Well, it's like a domino effect, one thing knocking over the next. First, that initial improvement just stalls. Turns out it was a false dawn. So now all those investors who rushed back in, they're trapped. They're stuck in these overexposed positions. Their flexibility's totally gone. They can't just sell or move things around easily. And at that point, trying to get cautious again becomes incredibly expensive. You're often forced to sell at a loss just to get out. So how do you actually avoid this trap? Well, it takes a more sophisticated mindset. We're going to call it smart positioning. And this right here, this is the absolute core of it. It's about being able to hold two ideas in your head that seem to completely contradict each other. On one hand, you have to acknowledge what's possible. That, yeah, this could be real progress. This might be the start of a real recovery. But on the other hand, you have to respect what's real, that a ton of risk can and probably does still exist.
So let's be super clear. This is not about being a pessimist. It's not about rejecting recovery at all. It's about respecting that uncertainty is still in the room. It really just means being prepared for either outcome.
Look, recoveries are powerful forces, but they can also be incredibly misleading. If this video helped you think a little more clearly about that, do me a favor and hit that like button. It really tells YouTube that this conversation is one worth having.
And I want to know what you think, so comment below, do you trust early recoveries?
And of course, subscribe to Finance Deep Dive if you want to stay ahead of these emotional cycles. And you're gonna want to, because in the next video, we're gonna show you exactly how wealth quietly transfers hands during these very moments.